One second.
Okay.
Okay.
Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown, along with my co-host, Mark Hanf of Pacific Private Money and Patty Cohen of Compass Realty. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate given away during this show. Let me try that again. The certificate's not sponsored by the radio station, but by Tan Bella Tanning Salon with 2 locations in San Francisco and 1 in Marin. Today's trivia theme, again, is just general trivia. Patty, tell us what is going on in the hot real estate market.
Well, everybody that is in real estate or even associated with real estate, whether they be inspectors or loan guys like you, everybody is on overdrive and it's intense and everything's an emergency and people are kind of flipping out. Now, sellers and buyers, same thing. The pace has always been frenetic, but it's ×2. And so everybody knows it's a great real estate market, right? So here's some actual numbers. Like I just took, for example, I've got statistics for the whole Bay Area by county, by city. I can dig deep if anybody wants these, any listener wants these, I can send them out. Yeah. But let's just look at Marin County, for example, right? So the Marin market is up 1,246 units. Well, what does that mean? Well, last year at this time, we sold 1,411 properties. This year, it's 2,557.
Wow.
Yes. And, it's not quite double. 28 would be double. But let's just look at volume, for example. Year to date, the volume is 4.744 billion, which means nothing unless it's relative. So last year at this time, it was 1,990. So double would be roughly 4 million. We're at 4.77 million. So that takes account for the increase in prices, which is over 20%. It's crazy. So there's this feeding frenzy to get a house. So honestly, like all that everyone's been talking about is the lack of inventory. Well, maybe it's not a lack of inventory. Maybe it's just demand, because if that many more properties are selling, okay, there is nothing on the market, but it's double the amount of business that we normally do. So people are selling.
But so here's the thing is, you've got, okay, everything was all COVID related before. Yeah. And now, some companies are requesting that their employees come back to work. So is there still this migration out of the city? What do you think?
There is, because even if they have to come back to work, some of them are doing it like on a half-time basis, and they can do it at different hours, so the commute won't be as bad.
Okay.
Yeah.
There's a lot of conflicting headlines, so I like to scour real estate news, and there's several consolidated websites that have a lot of different articles, and it's just as you go down and you read the different headlines, it's funny, Patty, because you mentioned, what's really happening here. Is it, do we have a lack of inventory? Is it like, here's a headline that's basically saying that, the market's cooling off. And they're saying that, the writer of this article is saying that because home sales, and this is nationwide, not necessarily in Marin where we had, nearly a doubling of unit sales, but nationwide, in April, they're saying sales are down, X percent year over year. And they say, well, as buyers and builders balk at rising construction costs, these headlines are written by people that don't understand the market, because that's not what's happening at all. There's no balking going on. Are people being priced out of the market? Yes. That doesn't mean they're balking. That means they can't buy the house. There is such a lack of enough housing units being built, and a lack of people selling their homes, because fewer people are selling their homes. People are living in their homes longer. So, clearly the inventory, I think, in my opinion, that we don't have enough homes available for sale, whether they're being built or sold by people who live in them.
Well, even in the fact that you've got, like you said, the supply of lumber, windows, all that stuff is taking so long. Even if builders wanted to build right away, they're still going to get they're still going to be pushed back in time, aren't they?
Yeah. But what's happening right now, the rising prices, the rising cost of materials is going to increase. There's going to be additional upward pressure on home prices, particularly new home prices, because builders aren't going to sell homes for a loss, or they're just going to stop building altogether. So we have continued constraints on the amount of homes available for sale, yet demand for those homes is continuing to increase. People want to move, people need to move, kids want to move out of their homes, renters want to become homeowners, particularly when they see the market going up, double digits year over year. They want to get in on it before, they realize waiting for the next recession is almost a fool's game at this point. So
it is, yeah.
In terms of now that doesn't mean I don't worry about certain things. I do. I'm worried about inflation because it seems like the price of everything is going up, but it's not so much inflation that worries me. It's what if mortgage rates go up significantly? How is that going to impact the market? And we'll keep talking more about that on the
after the break. Okay, here we go. Here's our first commercial trivia break. Question is, who reveals the man behind the curtain in The Wizard of Oz? Which character was that? Call 888-912-1190. The first caller with the correct answer is going to win that tanning certificate, which is worth over $100. Trivia question number 1. Who reveals the man behind the curtain in The Wizard of Oz? Which character was that? All right, stay with us. You're listening to The Best of Investing. Don't touch that dial. We're going to be right back. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hanf and Patty Cohen. Our first trivia question. Who reveals the man behind the curtain in The Wizard of Oz?
Toto.
Toto, that is correct.
Yeah, that's
the
right.
band that sang that song America or whatever, or Africa.
Yeah, that's right. That's where they got it from.
Raise of
And make a
Africa.
quick mention here for Palio Restaurant, which has been the premier Italian restaurant serving downtown San Francisco since 1990. It's no surprise that it's been voted best overall restaurant in San Francisco by San Francisco locals. Recently went through a complete remodel, and they have a brand new and more modern space. Visit them at paliosf.com.
How do you spell that?
PALIOSF.com.
Nice.
Good.
Nice.
All right, Mark, why don't you continue on?
So we're talking about kind of the fundamentals of what's happening in this crazy real estate market. And of course, you'll see blog posts about people predicting that a real estate crash is imminent. I still don't think that there's anything in the data or the metrics to suggest that we're going to have a housing correction anytime soon, and it's really just based on a supply and just a pure supply and demand perspective. Because even with housing prices going up, thanks to lack of inventory, and new home prices will go up because the cost to build them are skyrocketing. It does mean that there will be fewer people who will qualify for home prices as the price per square foot continues to soar. But because of the strength of the demand, the actual number of homeowners that are out there looking for homes versus the number of home units that are being put on the market on a monthly basis, I actually don't think, other than people will get pushed out of the market, there's still going to be people who can pay cash. There's a lot of cash sitting in people's savings accounts right now. A lot of people saved money during the pandemic. A lot of people made extra money, side hustles. People who've invested well in either crypto or the stock market are sitting on capital gains. I've talked to so many people on a regular basis that are looking for ways to purchase real estate, and they're out there competing in the marketplace with cash offers. So, nothing can last forever, and to think that we're not going to have another cycle would be foolhardy. But I don't think it's imminent, and we could still be a couple of years away from, topping out and having a downward cycle, hitting a recession, for the first time in, nearly 12 years. It's amazing what's happening. And, most of the economists I read, and Patty, I know you're in the middle of it, they just say there just doesn't seem to be any support for those who are either waiting for the market to turn down or are hoping the market will turn down to look for buy opportunities.
Well, you know what it is? It's the ultimate convergence of the blob of baby boomers who are moving down,
And we're a
and
blob, all
then
right.
millennials finally getting in the game. And you know, the expression like millennials are already late. And we've been talking on this show for probably 10 years about where are the millennials? Well,
Yeah.
the millennials are late and they're finally out. Now, what's happening is it's the convergence. The boomers and the millennials want the same thing. So I just got off the phone with a seller whose house didn't sell. It was priced at 6.7 million. And he picked it up on a foreclosure, and it's got like marble columns and arches and marble everywhere. So he's going, it didn't sell. And if something doesn't sell in a minute, it's a problem. So he did the math, he figured it out. He took the feedback that buyers don't want those kinds of houses. So we've got, you know, okay, that's just incredible demand. The story really is demand, but how is this going to be sustainable? Number one, real estate's the ultimate hedge against inflation. We have continued low interest rates. We have demand that is not letting up because those baby boomers are moving.
Yeah.
And those millennials are finally competing with them. And then we've got, you know, people are not wanting to, you know, at least in the Bay Area, nobody's building, but people aren't wanting to remodel. They're not, because we've got labor, because of the fires. Labor is really high, and lumber is really high, again, because of the fires and what's going on in Canada. So we have the ultimate, seems like this should let up, but it's not going to if you look at really what's going on.
Yeah, and so those headlines about the real estate market cooling or buyers balking at rising home costs or construction costs, that's just utter nonsense. That's not true. That's not real news. That's fake news. I'm going to go Trump on you guys. Fake news. Fake news. There's no market relief on the way, despite other headlines. Is relief from the red hot market on the way? A Redfin headline asks. No. Unfortunately, there's no relief because it's probably going to get worse. Prices are going to continue to go up, and you know, although mortgage rates went down again, and I slap my head every time I read an article saying, you know, the 10 years down again and mortgage rates are down, because everybody is expecting mortgage rates to go up, and not just a little bit, but a lot. You know, and when they do, it just means it's going to be harder to buy a home. So you know, I don't see real estate prices ever being in a position, not ever, but in the next couple of years, I don't see relief. In other words, if you can buy, you should buy, and you should buy now.
And what is the reason why the 10-year went down?
I didn't read the data on why it did. I just saw that it had yesterday. The 10-year had gone down, and and even the headlines saying why. Again, I'm not a fan of headlines. I mean, even the headlines in the Wall Street Journal, I think oftentimes are off. You need to read the body of the article, because the headline itself oftentimes makes an assumption on data that really I don't think is, you know, always accurate.
Yeah, I mean, you're right. Waiting for the next recession is a fool's game. Like my savvy clients are saying, I don't want to miss this market. And we've got at least 2 more years of it.
And,
I think
you know,
so.
even if you overpay a little bit, you know, who cares? Especially if it's going to be your personal residence. You're not doing it for investment purposes.
Yeah.
You know, you're doing it because you want to live there.
But yeah, we're not there yet. Not with this demand.
Not yet.
Yeah.
All right, we're going to cut to our second commercial break. When we come back, we're going to get into a couple of emails. One of them is going to be asking Patty, how long do we expect the housing prices to increase and at what rate? And for Mark, we're going to ask about the loans that he has in his portfolio. How long do borrowers usually keep those loans? All right, second trivia question is, who earned an Oscar nomination for her role in the movie The Color Purple? Call 888-912-1190. The first caller with the correct answer is going to win that tanning certificate. Again, here's the question. Who earned an Oscar nomination for her role in the movie The Color Purple? So again, when we come back, call 888-912-1190. First caller with the correct answer is going to win that tanning certificate. Again, when we return, we're going to ask a couple of email questions. Then I've got a couple of interesting things about job searches that fell in states that canceled unemployment early. Now, why would that happen? Seems a little odd, doesn't it? Well, we'll get into that when we come back. So don't touch that dial. The Best of Investing. We're going to be right back.
It's interesting.
Well, welcome back to the Best of Investing one more time. I'm Edward Brown, your host, along with Mark Honfa, Pacific Private Money. I was going to say president of Pacific Private Money, and Patty Cohen of Compass Realty. Our second trivia question: who earned an Oscar nomination for her role in the movie The Color Purple?
Is it Oprah?
No, you know, it's funny.
I was going to guess Oprah.
No, it was actually Whoopi Goldberg.
Oh, Whoopi.
Yeah, it's funny because I was thinking, I was wondering if it was either Oprah or Whoopi, but it was Whoopi. Whoopi! Okay. So before we get into email time, I read an article here that said job searches fell in states that canceled unemployment early. And here's the question. You'd think that's kind of the opposite, right? I mean, if theoretically, if they're going to get rid of unemployment, then it's like, okay, your job searching should go up. Now, I'm going to surmise that some of the people who wrote on the comment section in Yahoo were correct. And they said, there's too many phony, quote, looking for work. If you remember how unemployment works, you have to go, you have to try to get for a job. Sure, I'd like to be the CEO of General Motors. Here's my application. Right?
Ready, willing, and able.
Yeah. So, but, you know, and the problem with that is that the government is competing with employers because the unemployment benefits, I mean, $300 is not a lot, but, you know, if you're looking at a fairly low wage earner and you're going to get paid just a little bit less for sitting home doing nothing, which, if I remember correctly, California, you don't have to pay taxes on that. So you get a little bit of tax benefit. You know, you just can't have the government competing with employers. That's why there's so many of these, you know, help wanted, you know, and at some point, though, they just can't raise the wage too much because they'll price themselves right out. You know, no one's going to pay $85 for a hamburger, right?
Right.
So it's all kind of that mixing and matching on that. So.
Especially in the restaurant business. My son is an executive chef locally. And I went to Madcap last night. He used to work there, but you know, I asked, what happened to this guy? And he said, well, he's busy. You know, they're on unemployment. And in the restaurant business, they can't find anybody. Nobody's willing to work because they're kind of comfortable.
Well, you know, that's an interesting topic. I know it gets a little bit off our typical topic of real estate and investments, but, you know, can you imagine trying to live on $15 an hour? And here people are getting up in arms about raising the minimum wage, especially for restaurant and other service workers, to $15 an hour, you know, thinking, oh, well, they already make tips. But, you know, we all know people who actually work in the food service industry, and they don't make much money. Some do in some restaurants, but almost all of the restaurants are only now really reopening. And
it's hard. It's hard work, and especially
it's the most underpaid among teaching and food service. Seem to be, you know, some of the two, you know, most underpaid type of careers where you take a lot of abuse.
Can you imagine working at a lower end restaurant, let's say like a Denny's, and doing breakfast, which is the cheapest? You know, serving a steak is you know, is just as hard as serving eggs on a platter, right?
Yeah.
But it's all based on the percentage, you know, usually on the tip. So I mean, and everybody's on their feet almost the same amount of time. So
and then add to that, you're still working, but it's only, you know, partially open. So it's not 100% of the tips. Is it 50%?
Oh, good point. That's right. Yeah.
You know, and Edward, when you say no one's going to pay $85 for a hamburger, I mean, I think that it makes, you know, it's a joke, but it makes a little bit light of, well, okay, if a hamburger at a restaurant is $12 and to pay the clients or the workers $15 an hour, it's going to have to go up to 14 or 15.
Well, that's
when you go out for dinner, it's an experience, right? And I think all of us would be willing to pay. Well, I shouldn't speak for all of us, but I certainly would be willing to pay more for goods for food service, knowing that the people who are working there are not feeling, you know, abused and taken advantage of and working for.
But you know what? I'd rather them raise the price and not have this extra fee for health benefits or all this other kind of stuff that they, just these little additive things are kind of annoying.
Yeah.
I like the fact that you get to tip separately because, if someone does really, really good service, you want to tip more. If someone does really lousy service, you don't want to just automatically throw an 18 or 20% tip in there. But
Yeah.
all these little ancillary things that they throw in there, it's I'd rather them just, don't tell me about it. Just go ahead, raise the price to 14, 15, 16 bucks. Because you're right. I'm not going to okay, pay 12 bucks for a hamburger or 16 bucks for a hamburger. It's not going to really change, unless McDonald's charges me that, then I'm going to kind of get elsewhere. It's a difficult place. You're right. I'm not going to be too upset. All right, Patty, an email comes in. It says, how much longer can we expect housing prices to increase and at what rate? What we were talking about.
And I mean, again, you talk about the Bay Area versus other places because a lot of other places in the country are dependent upon, or you factor in new homes and building, but we just really don't have
because
that.
other parts of the country are starting to experience overpricing, or just overbidding and competitive. It used to be in the old days, California, let's say, nobody does a contingency sale, but you can still find it out of state. And now, even that, you can't.
All over the country. I talk
all
to
over the
realtors
place now.
all over the country, but I'm talking about like right now, it's hyper busy all over the country where you're going to get, 5, 10, 20 offers on things. But how long is this going to last is what we're talking about too.
Yeah.
And it is that convergence, like what is consistent all over the country is the convergence of the blob of the baby boomers. Right now, the middle of the baby boomers are 50, 65 years old, and it straddles at roughly 10 years on either side. So it's going to continue for a really long time. And then what happens too, because the baby boomers haven't been moving and the millennials haven't been buying. So we've got the millennials out there competing with the baby boomers.
Yeah.
That's not going to change.
Yeah.
And then real estate, again, the best hedge against inflation, that's not going to change. Interest rates, okay, they'll go up some, but it's still ridiculously low because we all remember 10%, I remember 20%, right? Yeah. So we have that, and then we have the cost to build. So maybe it's going to, in other parts of the country where there's a lot of building and new home construction, that might change things, but in terms of affordability, that index is not where, at least in the Bay Area, the affordability index is not as low as it has been when things burst. So people still have money. So how long is it going to last? I mean, my opinion, at least 2 years. We've got another couple
2 years.
Springs,
Okay. Patty, why don't you give out your information if people have more questions?
Sure. My name is Patty Cohen. I'm with Compass in Marin County, and my number is 415-722-4842, and email is great. That's Patty, P-A-T-T-I, .Cohn, C-O-H-N, @compass.com.
All right, here's our third trivia question. In Disney's Pinocchio, what animal does Pinocchio get trapped inside? Call 888-912-1190. First caller with the correct answer wins that tanning certificate. Stay with us. When we come back, we're going to ask Mark Hanf a question about his funds and the loans that he has in his portfolio. Don't touch that dial. Welcome back to the Best of Investing. Edward Brown here along with Mark Hanf and Patty Cohen. Third trivia question. In Disney's Pinocchio, what animal does Pinocchio get entrapped inside of?
It's a whale, right?
A whale, that's right.
What kind of whale?
What kind of whale? I think it was a
beluga whale.
I think it was a sperm whale, according to the shape of the whale that they usually use in there. You got to know your whales, right? It's funny because like Jonah in the Bible, he doesn't get actually swallowed by a whale. He gets swallowed by a big fish. So it's probably a parrotfish or one of those huge fish. All right. Mark, question comes in a little different than real estate. Okay. Of course, the real estate of a whale. How much does a whale charge for rent? I don't know. All right, Mark, question comes in. How long do borrowers usually keep your loans in existence? So give a little background.
So we probably have 3 types of private real estate financing loans, or I should say the borrowers kind of fall into 3 camps. We have super short-term loans known as bridge loans that where people borrow our money as a tool to close a real estate transaction that they either can't get bank financing for, or they had bank financing lined up and it fell through. I had one of those land in our lap this week. Or they're trying to compete with cash buyers. So they want to use, a consumer bridge loan to make an aggressive offer with no or low contingencies. And so oftentimes these purchase money bridge loans get paid off in 60, 90, 120 days, because for the preponderance of our financing programs, there's no prepayment penalty. And then the next ones are those who borrow it for a year and keep it for a year. They know how long they're going to need the money. They've done their due diligence on their investment. They're using our loan to basically bridge themselves to longer term financing, but they got to remodel the house first, something like that. And so they'll be, 6 to 12 months. Then there's the camp that those of us in this business have to be on the lookout for. That's the person who borrows money from you and then can't figure out how to pay it back and doesn't want to sell the property. And, and everybody in our business, in the alternative financing, private money lending business, we all have those. And a lot of those are guys that I'm personally, doing workouts with and continually rattling their cages and doing whatever we can to help them out, because at the end of the day, we don't like to foreclose. We'll do it if we have to. And we do a handful of foreclosures every year. But we have $250 million worth of loans under management right now in our service loan portfolio. So, we do a lot of lending, and the vast majority of that 250 million is continually rolling over, being paid off and then funded into new loans. And of that 250 million, about 100 million of that is in one of our 4 mortgage funds. We've got 4 different mortgage funds. They all have a different business model. We started out with our very first fund in 2013, and that one is still in business. It's called the Pacific Private Money Fund. It's paying in the low 7% return range right now, secured by about half long-term and then half short-term real estate loans. So we've got ones that are turning over quickly, and then we've got other ones that are construction in nature and or longer term hard money loans by people for whom a 9% loan is just, the cost of money to them. And then the other funds some of them are more short-term in nature. We have one new fund that specifically focuses on California construction loans and pays a higher rate. So it's an interesting, it's an interesting question and not a short, simple answer. It really is, it kind of depends on why they're coming to us for financing. And the reason why someone comes to a company like Pacific Private Money for a loan rather than go to the banks is A, the bank is probably not making that kind of loan, or B, they can't get it fast enough. And actually B, speed is probably the number one reason people come to us, is speed, followed by banks are not making that type of loan, or maybe they got a couple of pieces of real estate they want to use as collateral for a loan. Banks don't like cross-collateralized loans. That's really a private money loan product. So it's just, it's a very interesting universe. If the only mortgages you've ever had are the ones you've used to buy your home with, you're probably not familiar with how vast and varied, real estate lending has become. And you also wouldn't know that the what used to be called hard money, which then became private money, which is now basically alternative real estate financing, is the fastest growing segment of mortgage lending, and it's been growing year over year for the 13 years that I've been doing it, and will probably continue to capture a larger and larger piece of the overall mortgage lending pie, just because alternative is just so much easier for most borrowers to work with. So for more information on how you can borrow or invest on real estate secured debt and earn 7% or more on your money, you want to go to our website at pacificprivatemoney.com. That's pacificprivatemoney.com, or call our office. We are open for business at 415-883-2150, 415-883-2150.
Great. All right, we have a couple more minutes. What do you guys want to cover?
I just, again, scanning the headlines, Here's another one that's kind of related to what we were talking about earlier. Will rising inflation cool down or further inflame the hot housing market? So again, here's an article that I actually like because it doesn't try to make one claim or the other, because oftentimes an article about rising inflation would automatically presume that's going to put a damper on the housing market. But don't forget that here it says in short term, rising inflation could further inflame the housing market, leading to an increase in demand as more investors turn to real estate, because many believe real estate is a safe investment that will grow in value at a higher rate than inflation. And you mentioned that earlier, Patty. It's just like, when inflation rears its ugly head, your best bet oftentimes is to be in real estate, because real estate almost always outpaces inflation.
Right.
Anyway, so the bottom line is that nobody has a clear silver ball right now. Only that when you look at all of the data, you look at housing supply, you look at demand, you look at the cost of money, you look at how expensive it's getting to build homes, and that they can't build homes fast enough in the United States, and certainly not in California, to meet demand. It just seems as though the numbers would indicate that real estate values and prices are just going to continue to go one direction for the foreseeable future, and that's upward.
Sounds about correct to me. Mark, why don't you go ahead and give out your information one more time if people have questions about being a borrower or a lender?
Right. So at Pacific Private Money, we have two types of clients: those who are looking to invest their money for a secured return. All of our loans are real estate secured. We don't do any unsecured lending. And so we can pay you 7% or more for the use of your money in one of our 4 funds. And for more information about our family of funds, you'll want to reach us. And if you're looking to maybe compete with cash buyers because you want to move and your bank said, no, you got to sell first. And your wife says, or your husband, there's no way I'm moving first. We want to buy our next home. So we've got a bridge loan product that will allow you to tap the equity in your home today so you can buy your next home. So give us a call at Pacific Private Money, 415-883-2150.
Very good. All right. Stay with us. The Best of Investing will be right back with some closing comments. Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with Mark Honf. Patty Cohen had an emergency listing. Everything, she's just busy as crazy.
She was saying she's got 11 new listings this week. Oh my God. Any real estate agent would just die to have that problem. It's a good problem to have. And she wasn't complaining about it. She was just saying, how her phone won't stop buzzing. So that's a good problem to have.
Well, good for her.
Yeah.
Well, Mark, why don't you give us a little rundown on how well your funds are doing? Because I know that they're doing very well.
Well, we talked a little bit about the funds. I didn't go into a lot of detail. We've got 4 different funds. All of the investor capital in all 4 funds is used to invest in real estate secured mortgages. Our legacy fund, as we call it, the Pacific Private Money Fund, has a $65 million portfolio of loans and is paying a little over 7%. That's one of our most popular funds. The second fund, the second of 4 funds, is we call it the Pacific Freedom Fund, and that is a different kind of fund. It pays a flat 6% interest to people who make deposits into that fund, but we have no enforced lockup. So we use that fund to make very, very short-term loans or loans that we're going to sell to our institutional investors. So we're constantly revolving that capital, which allows us to basically treat it like a money market account for our investors. They can, if they sell real estate, they're sitting on $1 million and they want to make some interest on it. They can deposit into our Freedom Fund and earn that 6% yield. A third fund that we have is called the North Star Capital Fund. That's our construction lending fund. That's paying right around 10%. It has quarterly distributions as opposed to monthly, and it does have a 1-year lockup. Minimum investment in the North Star is 100,000. And again, it's paying right now year over year 10%, and it invests exclusively in California construction loans. Last but not least, we have a mortgage investing fund that's based in Texas. So no California taxes, well, unless you live in California, or you have to pay them anyway. But but if you have a residency outside of California and you want to invest in a fund that pays interest, but you don't want to pay the state of California, it's VIG. We've got the Pacific Southwest Note Fund that invests in long-term seller carryback notes that we purchase at a discount. And that fund pays a fixed return of 7.5%. Also with no enforced holding period. So again, it's a place where you can park your capital. Why do we have two funds with a fixed return, one paying 6 and one paying 7.5? Well, the Pacific Southwest fund that pays 7.5 is limited in how much money we can take in, because we only take in the money that we're only able to buy about $1 million worth of loans a month. Whereas the Freedom Fund, we have an unlimited amount of capital that we can take in, because we never have enough money for all of the loan volume activity that we have right now. So we're looking to grow the Freedom Fund aggressively right now. So for more information, PacificPrivateMoney.com, 415-883-2150.
All right. And here we are. We've got a few thoughts for the day on this one here.
All right.
So we'll start off with the normal ones. The secret of happiness is not found in seeking more, but in developing the capacity to enjoy less. You know who said that? Socrates. That's probably just before he drank the hemlock.
I don't think he had a whole lot back then in those
No,
days.
that's true. That's true. But he had a lot of hemlock, though. Okay. And no matter how many mistakes you make or how slow you progress, you are still way ahead of everyone who isn't trying. Tony Robbins said that. He's got a lot of good sayings, you know?
I like Tony.
I like Tony. Yeah, I like what he says. And my ex-wife still misses me, but unfortunately her aim is starting to improve.
Yes,
I thought you'd like that one. All right. Tune in next week to The Best of Investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.
See ya.